Good morning to my 10 subscribers. 2 weeks ago, Celsius was trading at $66. Today it's at $45. So here's the question. Why is the market willing to pay that price right now? What's changed and what does that say about what investors really believe about this company's future? So this wasn't a collapse in fundamentals. Celsius actually delivered 173% revenues growth year on year in Q3 and beat on adjusted EPS estimates. So why did this stock tank? Because of this. Surprise $247 million distributor termination fee related to Alani Nu, which is their new acquisition, healthy drink aimed at the more female audience. PepsiCo is actually going to reimburse this, but GAAP earnings got hit and investors panicked. Debt jumped to $860 million. Core Celsius growth came in at just 13%, flat with the category. So even though the top line was up huge, the story underneath looked messy, and the markets re-rated that risk. The sell-off might look overdone on paper, but there's more going on under the hood. Celsius's Q3 report exposed a few deeper structural issues. Core brand fatigue. Retail sales for the Core Celsius line rose only 13% year on year, well below the previous quarter. US market share slipped 50 basis points in a category driven by brand velocity. That's actually a red flag. Acquisition dependency. Growth is increasingly coming from Alani Nu and Rockstar, not the flagship brands. Alani's 114% growth looks great, but it highlights that Celsius now needs bolt-on deals to maintain momentum. And also financial noise. The PepsiCo transition added debt, distorted inventory levels, and introduced complex one-time accounting. Even though Pepsi's footing the $247 million bill, it clouds visibility into true operating performance. So what the market's really reacting to here isn't just a one-time charge, it's the loss of clarity and confidence. So at $66, Celsius is priced as a flawless growth story, 50% annual growth, clean balance sheet, Pepsi execution, high margins. At $45, the market message is clear. We don't fully believe in that anymore. Investors are saying, show us organic growth, show us control over debt, prove that Pepsi integration isn't going to dilute margins. And with the stock still trading at about 53 times forward earnings, even after the sell-off, it's not that cheap, is it? Now, to be fair, Celsius is still a growth company. It has a massive total addressable market in the energy drinks category. International expansion is just beginning. They only have 23 million in overseas in Q3. Ongoing flavor innovation and Pepsi distribution tailwinds are happening. So the story isn't broken here, but expectations have been reset. Investors now want proof, not promises. $45 isn't a disaster, even if it is 32% down from its all-time highs 2 weeks ago. It's just what investors are willing to pay right now for a business that still has potential, but now has to prove itself. And here's the real question. You only have so much capital to put to work. Is this the best place to put your money to predict growth right now? Or are there better opportunities in structural growth sectors like AI infrastructure, semiconductors, or defense, where growth isn't dependent on how many cans consumers buy next quarter? Because that's the ultimate call here. Not just whether Celsius can grow, but whether its growth is the best use of your capital in today's market. Thank you so much, guys. Please like and subscribe, and do let me know if you have any questions. A subscription really helps the channel out, and it's free for you to do, so I appreciate if you can do it. Thank you so much.